Today, I want to give you an example of an illustration from a live client. Change the names, change the information, but just some live data of showing you how we utilize inefficient dollars, which we showed you on one of our other videos, in our last videos, using finding inefficient dollars. And I want to show you how it accumulates the cash. And then from there, all right, so here's an example of a non-smoking 51-year-old female. And what we found is they had around $3,000 of inefficient dollars. And that was a combination of, overpayments, and pretty much everything. And they want to get out of debt as fast as possible. Again, you see the video prior, see our video on finding inefficient dollars and the definition of inefficient dollars. You'll understand where that money can come from. We took half of that just to give them an example. We could change this by your comfort zone, but the objective here is, and you don't have to be in debt. So one of our main focuses is help people get out of debt, because that's some of the largest problems. But there's some people that have money, they're storing in a place that they're not getting any returns on their money. They're holding it for a rainy day. And statistically, 70% of people, when they have money accumulated in a bank, 70% of the time, they don't even use that money. It's just sitting there. So it's not gaining interest. You're not making money. It's just, it's stuck. It's in neutral. It's not moving. It's not moving forward. We want to be able to maximize every dollar that you work hard for, that you've accumulated, so you can utilize every dollar twice. So let's give you an example here. They had over $3,000 in inefficient dollars, whether it was overpayments, money they were contributing to our RAs, 401ks, money they were just throwing in the bank, just a magnitude. And they had quite a bit of debt, but they were still comfortable, being able to pay it. Remember, every time you send money out and it's not utilized for you, that money's gone. You're never going to get it back. So you want to make money on every dollar you earn as much as possible. So I'm going to break this down for you. So this policy that we designed, you can have it different, but don't get worried about the numbers. They're just for illustration purposes. All right. So in this case, the monthly payment was going to be $1,750. Okay. That's the total. Now, if you see, it's broken down to 3 sections: the primary coverage, the flex pay coverage, and a 10-year term. The objective here is the tax code 7702 describes that you cannot overfund the policy, and then it becomes what's called a MEC, a modified endowment contract. So therefore, it changes the game, and any gains you earn or money that you take from the policy or borrow from the policy becomes a taxable event. So you should look up tax code 7702. Again, please read the disclosure. I am not a tax planner. I'm not a financial planner. I'm not providing you legal advice. What I'm trying to do is provide you education. This is more for educational purposes. 3 components of a well-designed policy. In this policy, what we did is we designed it as, okay, the coverage amount for the life insurance is $107,000. Okay, their total benefits $1.1 million. That's a nice amount of money to be able to leave for a legacy, and it'll continue to grow. We can make it smaller, we can make it higher. Just don't worry about the numbers. Look at the concept and the percentages of that. Of this $1,750, you got primary insurance coverage. So they're going to be paying $2,683 for the year for $107,000 worth of coverage. Okay, annual. I'm going to go to here, the flex paid up rider. Flex paid up rider, that's the cash acceleration portion. Now you're going to get cash acceleration here, but this is where you really put the top-notch engine on the vehicle. Okay, so you want to be able to put as much as you possibly can, and we give you room for gaps. We work with every client to see, here's the most you could put in. Here's your possibilities. You can put in 1 year. You can put in every 5 years, or you don't have to put in it at all. But right now, we gave you a gap here, and that annual premium for this is $15,744. I'm going to break this down on a monthly basis. You're going to see how that works. And the initial premium here is $1,312. So of the entire $1,750, $1,312 is accessible cash right away. That's about 68, 65 to 70%. So what you're paying for, you got immediate access. Okay. Now, and then the next part is the 10-year term coverage. So the objective of when it becomes to prevent it from becoming a MEC, modified endowment contract, is that you have to have enough insurance to be able to then put more money in it to fund your policy and be able to be liquid and accessible to cash. Meanwhile, you're getting a guaranteed 4% return. Pretty much anything you pay into the policy that is above the 1750, you're going to receive pretty much close to about 94%. There's like a 6% cost of the business. There's expenses from the insurance company. There's operating expenses, sales expenses, but this is the amount of coverage. And you right here, you're going to see that they got a gap between, let's just round this off. Let's say the 65 and 15. So they got about $50,000 in the ability to put in more money as the year progresses. And that gets every year, or they don't have to put in anything. From the term policy, we create the term, it's going to give you the million. Usually it's 10 times what the whole life part. So here's the whole life that everyone's always scared of, is because as a cash acceleration expert, or your family bank debt-free life expert, okay, and working with this company, I'm trained to design these policies to provide you the least amount of whole life, generate the most amount of death benefit, so you're able to put and take advantage of the amount of money you have access to and the amount of money that's consistently earning dividends and interest. So make this super simple. People get nervous when they see this. Oh my God, I got to get committed to that. No, that part, the most you need to pay is going to be, you have your initial premium. Okay. So the 1750 minus the 1312, right? So you got 1750 minus 1312 equals $438, but you got to pay at least $100 a year to keep this flex pay rider going. So let's just add $10 plus 10. So if a situation arises, all you need to pay to keep this policy in force and not worry about taxes is paying $448. So don't get paranoid on this piece, right? But as you're putting this amount of money in, you're going to continue to have this policy grow. So this number could be 500. It could be, we've done $200 policies. It could be 3,000, 4,000. It could be 1,000. But you're not committed to having to pay this. But this will help you, whether if you're in debt, you're not in debt. If you're not in debt, you want to store your money. Where are you going to store your money? In this case, this person had over $3,000 that they were paying extra overpayments that just goes out. When you're putting in here, you're consistently keeping the money, and then you're able to utilize that capital to pay off the debt, but you still keep your money. So you're utilizing the dollars to pay off debt, to buy large purchases. And when you borrow that money from the insurance carrier, that they're going to consistently keep you at the level that you're at as it relates to cash value, which I'm going to show you in 1 second. So again, we got $50,000 of room to add more to the policy if we want it at any given year. You could pay as little as $448 one month, go back to pay $1,750, pay $2,000. You have total flexibility, and it's liquid for you. Okay. So as you see here, these are the three components. Now, whole life's got a bad reputation. It's just because, one, it'll take you a good 10, 15 years. It takes a while to generate the money or get a decent return, but it's still a good policy. In this case, we're utilizing the whole life portion of the policy and the term policy to be able to, you're able to use it as a financial tool to finance items that you would normally be purchasing and paying that financing interest to someone else, and they're making money. Two sections. This is the basic illustration part in this particular policy. Made sure everything is gone. Okay. So in this situation, you have guarantee. Guarantee values include the interest. Okay. The non-guarantee includes the dividend. They can't guarantee you a dividend, but they've been paying for over 100 years. You determine whether you think they're going to pay a dividend or not. I have a policy. I'm pretty comfortable they're paying dividends. I have several policies. So in this case, at the 1750 over the year, they're gonna put in annualized $21,000. In the first year, they're gonna have a cash surrender value of which they can borrow of here. Their increase, they're gonna be able to borrow $14,829. And now the death benefit just moved up at the end of the year to 1.2 million. Not bad. So you have $14,000 worth of cash. This doesn't count that if you put any additional of that $50,000 in, of which 90% of it's going to go to cash value, of which you can take right out, but you're gaining an interest rate on it and the ability to gain dividends. You cannot do that in your bank today. You could borrow against this cash value, no questions asked, have the money in 3 days. Shoot, you could start the policy, submit a loan application, and in 10 days, you'll get the money. Okay, so now let's go year 2, 54, continue to 1750. Remember, that can go back down to $448. Now their cash value is increased to $16,000. Now they have $30,000 in cash value. Key component there. All the growth in here will not be taxed. It's protected through bankruptcy, the IRS. Your money is protected in here. You're able to utilize it in any manner you want. If you take a loan against this policy, which we would suggest instead of just taking cash so you can continue getting your compounded interest, compounded year over year over year, that loan is tax-free. It's not part of your income to debt ratio. And you could either pay it back on a monthly basis, you can pay it back on a quarterly basis, you don't have to pay it back. In this example, let's just go here. Let's say at 67 years old, you got a debt policy of 1.6 million is grown. You have cash available of about $293,000. If you took all that money out and you did tax-free and did whatever you wanted with it, they're only going to take it off of your death policy. So it's going to be 1.7 minus 293,000 plus any interest you owe, and your loved ones will get the remainder. Meanwhile, you have tax-free dollars you can take out. It doesn't affect your Social Security. It doesn't affect one thing. And during this entire time, you've either paid off, you've paid off your house, all your cars. You have all of those assets paid for. You no longer are paying money to any external forces. I'll be walking with you through this entire process and discuss with you the options. You want to take this money and move it and make more money. You want to borrow it and pay for purchases. You end up with the asset and your money. Today, you're saving the money, and then you're taking that money and you're paying it all off to buy something else. Why do that? Put the money in a policy, borrow from the policy. You still have your cash earning interest. You purchase the investment, you make the payments you would normally be making to someone else who's gaining the interest, but you pay it back to yourself. This is your own bank. Why would you steal from your own bank? No, pay it back to your own bank. You don't have to pay it monthly. You can pay it every 2 months. You can pay it every 3 months. You can wait 5 months. You can dump in money. It's the easiest way that I could help you and explain the power of utilizing high-paying dividend insurance policies. All right. How are you using your money twice? Right? If you just put your money in a bank account and it's just sitting there, you're using your money once and it's not making money from you. There's 4 ways of how we use money. We either spend it, we save it, we finance something, or we invest it, or we give it away. Right? That's how we utilize the money. So let me show you what you're going to do here is you put your money in a bank account, or you have it just sitting there and it's not going out anywhere. So it's not doing anything. In this case, you got expenses, you're paying your bills. You put in your checking account. Great. Following month, you're keeping your normal payments and you're paying out money, whether you're paying excess or you're not. You're paying off your debt. All of these interests, guess who's getting it? They are. Now, with the insurance benefit concept or your family bank concept, we're saying, look, let's, instead of taking the money and you're just taking in and pay it, let's redirect some of the inefficient dollars, the excess that you have. In that case, it was 1,070. It could be 300. It could be 400. It could be 500. You may have, 3,000, 5,000, 10,000 in the bank that you say, okay, let me put it in this as well. Let it sit there. So we're going to redirect those inefficient dollars, those overpayments, the contributions, your savings into one of these cash acceleration insurance benefit concept policies, right? It's going to be building cash value like I showed you. Okay. You're then going to borrow from the insurance company, not from yourself, from the insurance company, which is a mutual insurance company, which means what? You're an owner of that company. So if you're borrowing from that company, you're paying max simple interest, they're making money. And when they make money, guess who gets some of that money back? You. So you're paying it back to yourself. So whatever that interest is, you are paying it back to self. It's simple. So if you pay it back in less than a year, you're going to get 1/12 of every month that you paid it back, or you don't need to pay it back, or you can pay it back every 2 months, every 3 months. You're not stuck to a structured payment plan. We can go a little bit more in detail than there, but let's just look at the concept. So your cash value goes, you borrow 95% of it, the insurance company will provide it to you as collateral. You utilize that money to pay off your 6%, your mortgage, your 6% car, your Visa 12, your student loan. As you're utilizing that money, the money that's inside your own bank on you, continues to gain interest without losing a beat. It's uninterrupted interest. Einstein called it the eighth wonder of the world. So regardless of how the stock market is doing or not, it's going to continue to gain interest without you hurting it. And as you're paying back to it, you're going to gain more. So you're going to use that money, borrow, pay off the debt. And then once you pay off the debt, what you're going to do is the benefits is you're using your policy as a bank. You have living benefits. That's just an addition. You have death benefits. You have retirement tax favored money. Okay. You're accessible without any penalties. You can take the cash whenever you want. So what you're doing is you're paying off the debt. Once the debt is on this side here, so you're borrowing, you're paying this debt off. As once the debt is paid off, you're going to roll over and pay off and pay back the loan. So let's say the first, you're paying all your minimums and you have, I don't know, one of your credit cards you're paying $200 for, you're not paying the overpayment. Now you pay that off. Now you have $200 of cash freed up. You take that $200 and you pay it back to yourself in the bank until you can generate a next cash to snowball or avalanche and pay off the next debt, whatever that may be. If you don't have debt, you're just going to buy a car, pay it cash, and pay the payments you would pay to someone else back to yourself, to your own bank. So you get the interest back for yourself and your money continues to grow. You're going to roll it over. Then you're going to pay off another debt. And then once everything is gone, you freed up so much cash flow, you can decide to make that dump. You can do what you want, open up another policy, put it in a different retirement account, but a good retirement account. I would open up another policy.